Depreciation is how a business recovers the cost of an asset over time. You capitalize the purchase, then deduct it gradually for wear, tear, or obsolescence. Under tax rules, MACRS is the default system for most tangible business property. Intangibles often use amortization instead. On the EA exam, they'll test whether you know when you're in MACRS versus special first-year write-offs like Section 179 or bonus. MACRS works by putting property into a recovery class, like 5-year or 7-year, then applying the allowed method. For most personal property, MACRS is accelerated, meaning bigger deductions earlier. Real property is the big exception. It's straight line. Exam tip: don't confuse useful life in accounting with recovery period in tax. For MACRS, you follow the class tables, even if the asset lasts longer. For personal property, the class table is your roadmap. 5-year property includes computers and many vehicles. 7-year includes office furniture and fixtures, and it also catches anything else without a designated class life. 10-year hits things like vessels and certain agricultural structures. 15-year is land improvements like fences and roads. 20-year can include certain farm buildings. On the EA exam, 5-year computers and 7-year furniture show up constantly. Real property is where most points are lost. Residential rental property is generally 27.5 years, straight line. Non-residential real property is 39 years, straight line. The trick is classification. Residential rental means the building's gross rental income is primarily from dwelling units, think apartments and rental homes. Commercial buildings like offices, stores, malls, factories, and warehouses are 39-year. Also, elevators and escalators installed inside the building follow the building's life. When you're setting up depreciation, you use the class life table to support the recovery period you picked. The exam loves "what class is this asset?" questions. If an item clearly fits a listed category, use it. If it doesn't, 7-year property is often the default bucket for no designated class life. And remember, improvements to land, like fences and roads, are not the same as buildings. Those are typically 15-year land improvements, not 27.5 or 39. Finally, method consistency. Once you choose a depreciation method for an asset, you generally stick with it for that asset's life. If you want to change methods, you usually need IRS permission by filing Form 3115, a change in accounting method. One common allowed move is switching from an accelerated method to straight line. On the EA exam, watch for questions that sneak in "they just changed it this year" fact pattern. Think Form 3115. Which of the following assets used in a business would not be classified as listed property by the IRS? The options include photographic equipment, video recording equipment, farming equipment, and passenger automobiles rated at 6,000 pounds or less of unloaded gross vehicle weight. Think about which items the IRS treats as high-potential personal use property. The correct answer is farming equipment. Listed property is the category the IRS historically watched closely for mixed business and personal use, like passenger autos, cameras, and video equipment. Farming equipment is a tempting wrong answer because it can be used personally, but it's not in the listed property group the exam expects you to recognize. Cedar Valley Foods is a fiscal year C corporation using the accrual method, which requirement must be met for the company to deduct an expense. The choices mention paying before year-end, paying before deducting, meeting the all events test plus economic performance, or simply receiving an invoice. Think about the core accrual rule, not paperwork. The correct answer is that Cedar Valley Foods must meet the all events test and have economic performance to deduct the expense. Accrual taxpayers don't need to pay first, and they don't need an invoice specifically. The tempting wrong answer is receive an invoice because it feels like proof, but it's not the legal standard for accrual deductions.